Hello, everybody, and welcome. This is Bennett Tchaikovsky, the accounting professor, here with you on YouTube. Welcome to Financial Statement Analysis, and we're going to be looking at some more ratios. And today we're going to be looking at market valuation ratios. These can be extremely useful in terms of looking at companies, but my disclaimer and copyright notice is that the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2025 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So today we're going to go ahead and look at some valuation ratios, including earnings per share, the price to earnings ratio, the market to book ratio, dividend yield, and dividend payout ratio. So when we look at earnings per share, this is kind of actually already done for us on the financial statements. And let's kind of take a look at this. So the earnings per share, and the reason why this number becomes so important to us is because when we look at the price to earnings ratio, what we're really going to be kind of seeing is that, well, how over or undervalued is a certain company in the eyes of the marketplace. So let's go ahead and relative to the book value. So if I went to the 5 income statement, what you're going to notice is we've got over here of $4.61. Okay. How did this come about? Well, if I took the net income of $253,611, and this is really in millions of dollars, but multiply that by 1,000 to basically, these are in thousands. I'm then going to divide this amount by my weighted average shares outstanding. And I'm going to come up here with $4.61. So the way we're getting the basic earnings per share is by taking this amount over here, multiplying it by 1,000 because it's in thousands of dollars, and dividing it by my weighted average shares outstanding. Now, what is the difference between basic and diluted? Well, under diluted common shares, and this is a very fun topic for intermediate accounting part 2, when we take into account diluted earnings per share, if say we have warrants or options or other items that happen to be in the money, meaning that if the stock is trading at 10, I have an option to buy it at 8, it's in the money. So I would then assume that those amounts would be converted. And that's where you're getting the diluted earnings per share number from. But it's essentially the same thought process as I would be taking the net income, multiplying it by 1,000 to put the dollar amounts in thousands, dividing it by my diluted shares. And I'm going to get $4.60, which is what our value is right over here. So, but what I want to do though, and in a previous video, I went through and did trailing 12 months. And that's what I want to kind of focus on with you today for these market value ratios. So the first thing over here is that when it comes to preferred dividends, most publicly traded companies will not have preferred shares. And I know somebody will find a company that has preferred stock and send it to me and say, "Hey, Tchaikovsky, look at this. Yeah, we got this piece preferred dividends." That's great. I love those emails. It's exciting, right? I live for that stuff. So if you want to send that to me, that's fine. But for the most part, when companies go public, what you have to remember is when I go public, the SEC generally disfavors having shares that have like preferred liquidation preferences. Now, what do I mean by that? Well, with meta platforms, and we're going to discover why Mark Zuckerberg can never be voted out of power. Why can he never be voted out of power for meta platforms? Is because he has Class B common shares, which have 5 times the voting rights of Class A common shares. So you can have 2 different classes of stock, but again, you can't have, generally the SEC is going to want to see that those preferred shares get changed and converted into common when a company goes public. If I look at my friends at Snap, Crackle, and Pop, or Snapchat, and I look over here, and this is by far one of the most, I would say, blatant items. But right over here, I'm looking at all this stuff and saying, wow, this is pretty spectacular. Look at all these different versions right now. What you're going to notice is that if you have voting preferred stock, when Snap went public, pretty much all of these items were converted into Class A, B, or C voting shares. So again, and why do companies do this? It's essentially, if I look at Snap, so Snap stock price, if I do a maximum on this, it was trading at a high of God knows what, about like in 2021 during the height of the pandemic. So it's right now trading at one of its lowest prices. And it's got a market cap of roughly 13 billion. It has a negative P to E ratio. What does that mean? Well, if we looked at the most recent filing of Snap over here, if I'm seeing a negative price to earnings ratio, it essentially means that the company is still not yet profitable. Now, one kind of important thing to kind of like look at when we're looking at profitability, especially for a company like Snap, is that, well, you've got this loss of 262,000, but are they really losing money? And my answer to that would probably be no, because they've got this 250 million of stock-based compensation seemingly hitting most of the quarters. So when you have this stock-based compensation, it costs the company nothing unless you're basically paying cash to settle stock awards. In this case, they're basically buying this to basically do the repay, basically to pay back for the shares being issued, but they may not always need to go through and do that. So what you're kind of going through and seeing with a company like Snap is that, you know, even though a company might be at a loss, it's not really the true picture. So sorry for the divergence, but I couldn't help myself. And let's go ahead and get back to our company Five Below. So what I'm going to go ahead and do is I'm going to go ahead and basically look at basically for Five, my net income. So I'm going to go to my trailing 12 months. And in my trailing 12 months, and again, please watch the other video. It's basically where I look at the last 4 quarters. So it's going to give me a more recent value. So my net income over the last, basically over here, my net income is going to be as of, you know, and I should actually clarify this to kind of go through and say for EPS, we'll go ahead and call this 12 months, 8 to 25. And then we'll call this over here 12 months, 8/3/24, at least for this ratio. So my earnings per share right over here is giving me my net income. And this is going to be divided by my weighted average shares outstanding. So before I go through and look at this, just kind of note that the weighted average shares outstanding aren't really dramatically changing. So I feel comfortable in terms of going through and doing this. So if there were like a really big divergence, you would want to take that into account. But for our purposes here, we'll see if we can get close to the numbers. So right over here. Okay. So now, one of the things though, I need to kind of remember though, is that this amount here is in thousands. To make this comparable with the shares outstanding, which are in absolute shares, I need to multiply this amount up here by 1,000. So here, my earnings per share for the trailing 12 months is going to be 496. And here my earnings per share, the trailing 12 months will be $5.11. Just give me 1 minute. Okay. So now here's the big test to see if we did this correctly. So I'm only going to go ahead and do this as of the current date over here. So my price to earnings ratio is going to go ahead and hit 5. So my 5 stock price over here is 160.67. So if I come over here, and this is going to be as of 10/28/25, 160.67. Okay, and my earnings per share on a trailing 12 months basis is $4.96. So my price to earnings ratio for 5 below is going to be 32, the number 32. And when I go over here to basically look at 5 below, look at the price to earnings ratio. So it looks like we did this correctly. Okay, now, what does this 32 mean? Okay, and this is really where we get into some kind of crazy stuff. What this means is we'll take 5 below 32 years to earn back its stock price at the current level. Again, this is a way of saying how over or undervalued is a particular company. Okay, so again, how over or undervalued a particular company is. Okay, so that's the price to earnings ratio. Now, if we look at some other companies, and this is, I'm just kind of showing you, and again, I don't know if this is exactly right. If we say the Ford stock price, and if I look at Ford, and I'm going to go ahead and do a little bit of a deeper dive and look at this, the Yahoo Finance chart. So the price to earnings ratio is 11. What does that mean? It means that Ford is going to take 11 years to earn back its stock price. If I go here and take a look at Tesla. So if I go to Tesla, I see a price to earnings ratio of 279.89. Let's go ahead and do a little bit of a deeper dive. I see a different PE ratio here of 317. Which one is correct? I don't know. I would need to go through and do this. But what does this mean? It means that it will take 317 years, right? Basically, my price to earnings ratio, it's going to take me 300 years to earn back the share price currently of Tesla. So this is just giving us an indication. Is the stock overpriced or underpriced? We don't know. And what I would also tell you, and I usually share this with my students, and I feel as though for my accounting 1A students that I was trying out for them yesterday when I was talking about this stuff. But when you look at this from the perspective of, like what exactly, does this mean? But well, why is Tesla look more favorably, say, than Ford? Well, the problem is for Ford and for GM is that they have to go through and sell their cars through dealerships. They're tied to the dealership model. It is a very, very difficult market to be going through and working through, right? Because it's more challenging in terms of going through and, kind of getting that, it's a much more of a challenging situation. So when you're the market, the way they look at Ford, the way that they look at GM, it's a lot of it. Again, if we did here GM stock price, because, really GM may be a better comparable than Ford, and GM is more highly valued by investors because it's trading at a higher price to earnings ratio. Again, is this correct? Well, the price earnings ratio, this is showing 13.33. So someone's definitely not right, right? So this is exactly the same information, which is why when I look at GM, you never want to believe anything you see. You want to go through and compute this on your own. I don't know which one is correct. So, but I could go through and figure it out. Okay, so let's now move over here to going ahead and looking at our other one for this. So we're just going to go ahead and do the price to earnings ratio just for the most current period of time. If you're taking my class, don't worry about doing a prior period. It's more relevant just to be looking at this in the current one. Okay, now for this one over here, what I need to kind of go through and do is to look at the market to book ratio, which is going to be the market price per share. And this is going to be 160.67. And I'm going to basically be dividing this by my book value per share. What is the book value per share going to be? Well, it's going to be the total equity divided by the number of outstanding shares. Now, this is going to be a little bit different because this is going to be as of whatever that period end is. This is weighted average. It's not going to be too different. But let's go ahead and go to SEC.gov, because what we're going to want to do is we're going to go ahead and pull up a more recent balance sheet for 5. So let's go ahead and do that. So I'm going to go ahead and go to the quarterly report, and I blew it. Sorry, guys. Sorry, everybody. I'm going to go ahead and take a look at this. I'm going to go to financial statements. I'm going to go to consolidated balance sheets. And what I'm going to go ahead and do is I'm just going to do a big copy and paste. And I'm going to come back over here to my 5 below. Okay, and I clearly see something here that was from one of my other classes, my Accounting 1B honors class, where I was kind of going through and walking them through how grading happens. It's always exciting. Okay, let's see if we copy and paste. Uh-oh, yikes. Looks like we're going to get the same thing that happened a little bit earlier on. Let me see if I can fix it. Just give me a moment. So I had to do some some fun stuff because sometimes I can't work the magic of my computer, but that's okay. So let's just kind of take a look really quickly over here. So when we're looking at the balance sheet, and now it's showing it me in millions of dollars, so it's okay. So when I take a look over here, my total assets were 4.339574, 4.339574. So I'm on the right track. So let's go ahead and do this. So we need to figure out basically what is the book value per share. I'm going to go ahead and take the total amount of my equity. So I'm going to go over here to my balance sheet, my total shareholders' equity. The most current amount is 1.9 billion. I'm going to divide this by my outstanding shares. My outstanding shares right over here it's telling me that I've got 55, 146, 485. So this is in dollars. And this over here is going to be in my number of outstanding shares. And this is going to be as of 8/2/25. Let's make sure I got that right. 8/2/25, 8/2/25. So my book value per share is roughly $34.59. So my market to book ratio is roughly about $4.65. Excuse me, 4.65. Should not have put that in dollars. Okay. So it's basically 4.65 times book. Let's go ahead and take a look at our ratios and kind of reflect on this for a moment. So we looked at earnings per share. We also looked at the price to earnings. We talked about that extensively about, how is a company over or undervalued, right? And then we look over here, the market to book ratio. Market to book ratio is a financial metric that compares a company's market value to its book value, whether it's overvalued or undervalued. Now, the one thing we can also go through and do, and this is not going to be applicable to Five Below, and I'll explain why. But when we go ahead and look at Five Below, what we notice here is that in terms of Five Below's intangible assets, right, which I wouldn't call operating lease assets intangible because it is intangible technically, but I view more things like goodwill and other things like that. But really over here, you don't really have any intangible assets. So what I'm going to go ahead and say over here is basically not applicable. Five does not have any significant intangible assets, right? What exactly are intangible assets? It's going to be goodwill. It's going to be goodwill, patents, trademarks, intellectual property. And to show you an example of a company where it would be relevant, I take a look at General Mills and I come over here to General Mills and I look at their balance sheet, right? So, and boy, oh boy, does General Mills has some goodwill, right? They've got roughly about 22.7 billion of goodwill and other intangibles. So if I was going through and doing this from a perspective of the market to book ratio, is I would take the shareholders' equity of 9.5 billion and I would subtract out the intangible assets. What happens? The number goes negative, right? So if you're looking at a company that has a high amount of intangible assets, this is something that's going to be relevant to us because, again, one ratio is not going to kind of go through and determine the fate of the world, but it's something we need to go through and to figure out. So again, if they have intangible assets, you would take equity minus the intangible assets and divide it by the outstanding shares. The only difference between these two is that this is going to be more conservative because this is only looking at tangible assets. However, for a company like General Mills, you can make the argument that, well, what does General Mills really do? We say, so General Mills has made a lot of different acquisitions, and this is why they have so much goodwill, right? So they bought Pet Organics, Blue Buffalo, so a lot of different stuff. So there we go. Okay. So again, over here now for dividends. Does Five Below pay dividends? Let's find out. Like sands through the hourglass, so are the days of our lives. I'm sure you guys are putting me on like ×4 speed if you could. Always fun, but I like doing this because it's kind of more, it's fun that way. Okay. Okay, so looks like to me, if when I typed in dividends or dividend, they've got a credit agreement that basically, absent lender approval, the ability of the company and serve its affiliates to, among other things, pay cash dividends. So that's probably not going to be happening. So for Five Below, we're just going to go ahead and say not applicable. Five does not pay any cash dividends. Okay, so If I were, though, to kind of go ahead and do this, if you're dealing with a company that it's a more traditional company, you would just go ahead and figure out what are the annual dividends per share. I would go ahead and divide that by my market price per share, and then I would put it as a percentage of the yield. Then over here for the dividend payout, I would look at the dividends paid divided by the net income, and that's basically going to tell us how much these go through and get paid out. So there you go. Those are my market value ratios. I want to thank you for joining me here today. So dividend yield, again, dividend payout, again, for a lot more. This is going to be more for traditional companies. A lot of larger companies will not pay dividends, but I want to thank you for watching. Please do not forget to like and subscribe. If you got questions, feel free to send me an email message or leave a comment on the video. Look forward to the conversation, and I will see you on the next video. Have a great day.